Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And I just want to take this time to thank everyone for tuning in to this week's episode. We have a whole lot of different topics to go over this week, but in particular, we're going to be focusing on that generational shift away from high growth speculative technology and e-commerce stocks and into some of those more boring old economy areas of the stock market, such as industrials, the banks, energy, and select areas within the consumer class. So we're going to go over all of that today, but let's go ahead and get started. Now, the title of this week's presentation is The Old Economy Strikes Back. Now, the reason why we're really focused on this is that every single time that we've seen, maybe not every single time, but most times that we've seen in the stock market throughout history where we get this broad style shift away from growth and into value, or away from value and into growth, those shifts tend to be counted in years, not in weeks or months. And so when it starts to take place, we have to take notice, we have to take action, and we have to change the way we invest. And that was what we did earlier this year. The only thing that really interrupted the broad long-term move away from growth and into value was that short-term temporary blip caused by COVID. And as we mentioned this summer, we had the months of June and July and August where performance wasn't great. And a lot of that was due to the impact of COVID. But what we did say was we need to stay focused on the long-term shift that's taking place. That the big picture is what matters. And as COVID cases come down, we expect these stocks to reflate, tying into the broader reflation story. And that's so far what has happened. We expect that to continue. Will there be blips along the way? Absolutely. But long-term, what we believe based on our research is happening is that forgotten areas of the stock market, those old economy stocks, otherwise called value stocks, are assuming long-term leadership. We want to pull out that 2002 to 2007 playbook. What performed well during that time period? What performed well between 1950 and 1980? Both periods of rising interest rates, rising inflation. That's our blueprint. So 3 key takeaways for this week's presentation. The economy is strong, ladies and gentlemen. We need to move away from this market crash mentality. What's the next crash? What's the next crisis? Don't worry about that stuff. It only distracts us from our long-term goals. It pries us away from holding valuable long-term investments in individual companies that are going from good to great. We need to stop getting distracted by this crisis mentality. That's what leads to subpar returns. Number 2, old economy stocks are where we want to be, and we want to sell that new economy craze that everyone already owns and they're already priced to perfection. Third, and certainly not least, is that energy and bank stocks are leading that shift to value. So within that broader shift of value, there's that subgroup of leadership. We think that so far that is going to continue to be dominated by energy and bank stocks. Now, what happens during these reflationary cycles? Most of us on Wall Street, most individual investors, most advisors have not really experienced a long-term period of rising interest rates. Since 1980, we've been in a long-term secular decline as it relates to interest rates and as it relates to inflation. That is broadly starting to change. And as a result, we need to change some of the rules that have dominated the stock market over really the last 30 years, with the exception of a 2002 to 2007 blip. During periods of rising interest rates, old economy stocks, the nuts and bolts of what we call the fundamental economy, tend to outperform what we call the speculative new economy types of stocks, right? So in this case, industrials, banks are in that old economy bucket versus, new, what we call new energy stocks, such as our clean energy stocks, such as solar or if we're looking at e-commerce, artificial intelligence, that would be sort of your new economy types of stocks that we want to try and avoid during periods of rising rates. And what we can see here on this chart is that when interest rates are on the rise, value outperforms growth. When rates are declining, growth outperforms. And of course, we can see here 2002 to 2007, we again had value outperforming. So as interest rates move up, growth distribution, so the amount of economic growth that's being distributed widens out because more and more companies and people are participating in that growth as a result of higher nominal economic growth. And as a result, value outperforms growth. We see signs of a generational shift. Now, we showed this chart last week, but I want to show it again because it's important. When we get, one of the things that we look at is relative performance between different investment styles, right? In this case, growth versus value, which is outperforming which. Now, when the 2-day percentage change or the volatility of prices over a 2-day period starts to get really out of whack, in other words, we're seeing 2% moves to the upside, 3-4% moves to the downside on a day in, day out basis. We get this, what we call clusters of volatility after a subdued period. That tends to coincide with a shift of investment style. So we saw it here in the late 90s and early 2000s when growth was shifting to value. We saw it again in 2008 when the value period was coming to an end and we went back into a period dominated by growth. And now we're seeing it again. And we think that this is the sign that value is about to outperform growth. So what are some of the portfolio adjustments that we've been making this week? We added weight to Marriott and MGM resorts. Why is that? The economy continues to reopen. COVID cases are coming down. We want to press the gas on these reopen themes. Third, Synovus Energy. Within energy, what we want to focus on is value. In terms of valuation, we want a low PE. We want less focus on production growth and more focus on capital distribution back to shareholders. These are the factors that are going to tend to outperform, not just in the market-wide basis, but also within each sector. So we added Synovus, we reduced, we actually sold ELG Resources. Why? Because they have some global exposure. We want to narrow our focus on North American energy production. And then lastly, we did sell Ethereum. We love Ethereum, but if we do think that we're getting this broad rotation into value and away from growth, it's really hard to marry the two views. And so when interest rates rise, speculation tends to get popped. And so we want to be really, really careful. We could be wrong. Ethereum could go up and it would be great if it did, but we just want to be really careful with client capital and focus our areas and where secular leadership is going to be. And in this case, it's in the value areas of the stock market. We talked about the jobs market. The total job openings has gone absolutely ballistic, parabolic, whatever adjective you want to use. But the bottom line, by looking at this chart here, we're not going into a recession. So let's take a step back, regardless of your political views of who's in the White House, the economy is in good shape. So we want to use this advantage to put our money to work and ideally make some money. So over the last couple of weeks, the S&P 500 has definitely had a period of volatility. And what we noticed, and we've been saying this for a while, is that underneath the surface, most stocks were already in a correction. We saw it in our own performance, right? So if you own individual stocks, chances are, unless you own FANG, that over the last few months, you've probably seen those stock prices go down. The difference now, though, is that not only is the S&P 500 starting to bottom out, more and more stocks, fewer and fewer stocks are making new lows. So as the S&P 500 sold off, what we see here is 63% of stocks initially made new 20-day lows. Then only 41% of stocks made 20-day lows, when the stock market hit its new low. And then in the most recent sell-off of this week, only 26% of stocks were making new lows. More and more stocks underneath the hood of the market are participating in the rally. So the value line relative to the S&P 500 measures the amount of stocks. So in other words, takes all of the stocks on the NYSE and says, what's the direction of the stock market based on the number of stocks that are rising versus declining? So it doesn't take market cap into consideration. And what we see here is despite the S&P 500 selling off, more and more stocks are starting to rise in price. What does that mean? Well, that means most of the sell-off is being driven by the biggest companies in the S&P 500, which are FANG, Google, Apple, Netflix, Tesla, all of those technology stocks that we keep talking about. Technology is the one leading the sell-off, while all other areas of the stock market are starting to come back. And we see that in our own performance. Financials are taking the lead. So this is kind of speaks to what we were talking about last slide. Software selling off, financials and banks swinging up. Stock picking matters over the long term. And we see here within financials, the amount of investor flows into the XLF, which is the financial ETF, already washed out. So by the time the stock market started correcting in September, financials were already done correcting. The same with energies, we'll see here in a bit. And we can see here the financials relative to the S&P 500 have started to swing up. Then we look at energy and both energy and the banks. Both of these sectors have very, very strong breadth. Over 95% of energy stocks are trading above their 200-day moving average. And more recently, the percentage of energy stocks trading above their 50-day moving average is close to 100%. So in other words, that short-term action is strong upward and to the right, versus if we look at technology, yes, there's 66% of stocks trading above the 200-day moving average, but only 30% of those stocks are trading above their 50-day moving average. That's what we call deteriorating breadth. Fewer and fewer technology stocks are rallying, while more and more energy stocks, more and more financial stocks are rallying and leading the charge. We can then see here, energy stocks, that strong breadth thrust that we had earlier in the over the past month. The percentage of stocks at 65-day highs expanded to 72%. You don't see this during sector tops. This is very emblematic of a very healthy long-term bull market within a certain sector. Then we look at energy versus tech. Semiconductors, the percentage of stocks trading above their 200-day moving average is starting to fall apart. Again, very consensus long in the stock market. Most people are long semiconductors. We are not. But what we wanted to point out here is the deteriorating breadth of a consensus long trade in technology versus the relative strength of energy, which is swinging back upward and to the right. So relative strength improving in energy, relative strength deteriorating in a lot of these common themes such as technology and semiconductors. And of course, everyone hates energy. You know, it was not popular for us to go long energy. We got a lot of pushback on this, but that the evidence and the numbers continue to lead us that energy and banks are leading the charge. We can see here, most of the market remains short energy stocks. That to us tells us we have a group of forced buyers in the future to push those prices up. And then if we look at what coal and natural gas are doing in Europe versus what oil has done, oil's going to catch up. We're already seeing evidence that a lot of power stations are switching away from natural gas and into oil just because oil is so much cheaper. That's going to take about 500,000 barrels per day of oil off the market. So we're already seeing a tight market in oil that's going to be exacerbated by what's taking place in the coal and gas market over in Europe and in China. Now, as it relates to credit risk, we continue to see those credit risk premiums falling. That's a good thing, ladies and gentlemen. The foundation of the market remains healthy, and that's what we want to see. So overall, after many years of durable technology leadership, we are seeing a strong shift over into old economy stocks. Those old economy stocks are starting to dominate market leadership. We want to be there, and we want to be there over the long term, so long as the evidence points that way. So we want to stay focused on stocks with attractive valuations in the old economy that have identifiable catalysts to unlock that value over the next 6 to 12 months. Second, energy and financials are leading the charge. And lastly, the economy is healthy, ladies and gentlemen, and jobs are plentiful. Thank you so much. I know this summer we had a period of rough performance as we were transitioning the portfolio away from the new economy and into the old economy. I think we're starting to see that bear fruit. We still have a lot of work to do, but we're going in the right direction. We like the way the portfolio is constructed, but certainly we're taking this one day at a time, 1 week at a time, et cetera. If anyone has any questions, please feel free to reach out to your advisor, and we would be more than happy to answer all those questions that you have. Thank you again, and have an absolutely fantastic weekend.